Assalamualaikum and a very good day to our lecturer, Dr. Nolida. We are from group number 17. Me, Ayman Arif bin Amir Arifin, alongside with Muhammad Farhan Arif bin Muhammad Zain, we will be presenting the efficient markets and behavioral finance. Let's start off with the introduction. Now, what are efficient markets? Efficient markets refer to the degree to which market prices reflect all available relevant information. A truly efficient market eliminates the possibility of beating the market because any information available to any trader is already incorporated into the market price. As the quality and amount of information increases, the market becomes more efficient, reducing opportunities for arbitrage and above market returns. Next, the three degrees of market efficiency. There is weak, semi-strong, and strong. Now, for the weak degree, it is when the past price movements cannot be used to predict future prices, and if all available relevant information is incorporated into current prices, then any relevant information can be obtained from past prices is already incorporated into current prices. Semi-strong degree is when stocks adjust quickly to absorb new public information. This is so that an investor cannot benefit over or above the market by trading on that new information. In other words, both technical analysis and or fundamental analysis would not be reliable strategies. However, private information that is unavailable to the market at large will be useful to gain an advantage in trading. And last but not least, the strong degree of market efficiency. Now, this form believes that market prices mirror all data, both public and private, building on and incorporating the weak form and the semi-strong form. While holding the assumption that stock prices reflect all information, no investor, including a corporate insider, would be able to profit above average even if he were aware of the new insider information. There are a few examples of an efficient market. First, the passing of Sarbanes-Oxley Act of 2002 that required greater financial transparency for publicly traded companies caused a decline in the volatility of the equity market after a company released a report in the first quarter. Financial statements were regarded to be more credible, thus making the information more reliable and convincing for investors at a certain price of a security. As a result, there were fewer surprises and fluctuations. Now, this change in volatility pattern is proof that the passing of the Sarbanes-Oxley Act and its information requirements increased the efficiency of the market. Therefore, increasing the quality and integrity of financial statements is a method that can be used to lower transaction costs. Another example is when there was this one case that when a stock was added to an index such as the S&P 500 for the first time, there would be a large boost to the price of the share, simply because it became part of the index and not because of any new change in the company's fundamentals. This index effect anomaly became widely reported and known, and has since largely disappeared as a result. In other words, as information increases, markets become more efficient and anomalies are reduced. The study of market efficiency has been going on for years. However, there are four arguments against it. First, the size effect. Second, excess volatility. Third, the seasonal and day of the week pattern. Fourth, short run effect and long run return reversals. First, the size effect. Now, small companies have the inclination of generating larger returns than company stocks over longer periods of time. Therefore, it is reasonable to suggest that an investor should rather be interested in the extent to which high returns of small companies represent a predictable pattern that allow investors to make excess profit. As stated by Malkiel 2003 in his research, if the beta measure of systemic risk from the capital asset pricing model is accepted as the correct risk measurement statistics, the size effect can be interpreted as indicating an anomaly in the market inefficiency. Because using this measure, portfolios consisting of smaller stocks have excess risk-adjusted returns. Furthermore, in a study by Fama and French in 1992 reveals that the average relationship between beta and return during the 1963 to 1990 period was flat. This is not consistent with the upward sloping as predicted by the CAPM. In other, In one of their exhibits, within the size deciles, the relationship between beta and return continues to be flat, suggesting that size may be a far better proxy for risk than beta. For that reason, their findings should not be interpreted as indicating that markets are inefficient. Next is the seasonal and day of the week pattern. Now, this argument would be easier to understand if put into an example. Now, according to some study, January is an unusual month because stock market returns are typically very high during the first 2 weeks of the year. This has been especially true for small company equities, as the so-called January effect for large company stocks appears to have faded in recent years. There appear to be a lot of day of the week effects, as a French in 1980 study found that Monday impacts are much stronger. Now, the problem with this reasoning is that while it appears to be predictable, it is not always so. Even if the non-random effects were reliable, the transaction costs associated with attempting to exploit them are insignificant. Investors have not been seen taking advantage of January's abnormal returns by purchasing equities in December, and therefore erasing the abnormal returns. Next is excess volatility. Now, the critics believe that the stock market appears to display excessive volatility, that is, fluctuations in stock prices may be much greater than is justified by fluctuations in their fundamental value. It appears that criticizing the efficient market hypothesis based on the fluctuating asset price is conceptually wrong. Now, this argument backs with Safar's 2010 review, which claims that efficiency is about rationality and information rather than stability. And this study reveals that variance boundaries and stability are not elements of market efficiency. Hence, one should not reject market efficiency on the basis of excess volatility tests. And last but not least, the short run effect and long run return reversals. Now, when stock returns are measured in the short run, several studies show that there are some positive serial correlations within days or weeks. Many other studies, on the other hand, have shown evidence of negative serial correlation, which is return reversal. Mean reversion is another term for return reversal. Now, this suggests that stocks that have performed poorly in the past are more likely to perform well in the future, since the future price will be predicted, implying that stock price are not a random walk.
Hi, my name is Muhammad Farhan Arif and I will continue with behavioral finance. This section more criticism of efficient markets than standalone concept. Without efficient market hypothesis, behavioral finance would not exist. Behavioral finance examines psychology underlying investor decision and suggests that price movement is influenced by irrational investor behavior. It does not offer investment miracles because it does not tell investors how to outperform the market. It may help investors to be mindful of their behaviors and try to avoid making mistakes that make them incur losses. Okay, so how could inefficiencies survive in a world where a large number of rational and energetic investors stand ready to exploit any unusual profit opportunities? Limit to arbitrage. In a practice, arbitrage is defined as a strategy that exploits market inefficiency and generates superior return when prices return to fundamental values. The efficient market hypothesis states that whenever a publicly traded stock is mispriced, sensible traders have low risk profit opportunity. The low risk profit possibility is available through the arbitrage technique, which involves purchasing and selling things of the same value at various prices and pocketing the difference. If a stock's equilibrium prices decrease as a result of logical trading, rational investor will take a long position while shorting a proxy security or another stock with comparable characteristics. So, why might prices depart from the fundamental values? The first one is attitude toward risk. When making risky decisions, people are particularly unwilling to incur losses. Once investors have suffered loss, they even more concerned not to take a risk of further loss and a high return on compensate for it. Project managers must establish a routine for assessing and responding to risks across the organization. One issue with risk management consistency is that people logically have different attitudes toward risk, and those attitudes change depending on the situation. Other than that, it is beliefs about probabilities. When judging the possible future outcome, individuals tend to look back at what happened in a few familiar situations. As a result, they are led to place too much weight of a serial number of recent events. 5 lessons of market efficiency. The first one is no financial illusion. In effective market, there is no financial illusion. Therefore, investors are not excited with the firm's cash flow and portion of those cash flow which they are entitled. Companies can choose between two methods, FIFO and LIFO. Okay, so when inflation is high, the cost of the good bought first likely to be lower than cost of bought last. So FIFA appear higher than LIFO. The lower apparent earning using LIFO, the lower tax payment. If market is efficient, investors should welcome LIFO accounting. The second one is market have no memories. This stresses weight from efficiency and clearly implies that attempts at timing the market for bond or stock issue are unlikely in value maximizing decision. Historic price and recent rents are not much help in forecasting market trend. It forms the past track of security that could forecast a bit of future price. Therefore, at the price where security is likely next to up and down and the mean is zero, generally it follows random walk. Okay, the third one is the market price. The market price can tell us a lot about the future. Security prices typically reflect what investors expect what to happen in the future because they possess all the information. Security prices can tell a lot about the future if we can interpret them properly. The stock market is a good leading indicator of economic activity. The detailed information required to assess future prospects and high chances to gain abnormal returns. No way for more investors to achieve consistently superior returns. Okay, number 4. Do it yourself alternative. In an efficient market, investors will not pay others for what they can do for themselves at lower cost. As we shall see, many of controversies in corporate finance center on how well individuals can replicate corporate finance decision. So, for example, company often justify mergers on the ground that can produce more diversified and hence more stable firm. It's much easier and cheaper for them to diversify than it is just for the firm. So the last lesson is read the entrails. If the market is efficient, prices impound all available information. Therefore, if we can only learn to read entrails, security prices can tell us a lot about the future. For example, suppose that investors are confident that interest rates are set to rise over to the next year. In that case, they will prefer to wait before they make long-term loans, and any firm that wants to borrow long-term money today will have to offer the inducement of a higher rate of interest. Okay, the conclusion. In this chapter, the market efficiency is defined as informational efficiency that has ability to price securities fairly and quickly. In other words, it tells how well the price reflects available relevant information. Financial managers have to deal with financial markets routinely. It's very important to understand the concept of market efficiency and its implications. No one can regularly purchase and sell quickly enough to gain from the knowledge since the market is efficient. With prices moving so quickly as new information about a company emerge, as a result, neither you nor professional money managers can consistently outperform the market instead of attempting to outperform the market. Supporters of efficient market theory argue that you should index or buy and hold all of the market equities. That's all from me and Aiman. Thank you.